Hey traders, if you're looking to take your trading game to the next level, you're in the right place. In today's video, we'll dive deep into one of our most powerful advanced entry strategies, the Fair Value Gap FVG trading strategy. This approach is built on smart money concepts, and we will show you exactly how to identify and trade FVG setups effectively. If you want to refine your trading skills using an FVG trading strategy, this video is for you. We will walk you through a step-by-step process to apply this setup on any chart, ensuring you follow all the mechanical rules necessary for precision trading. If you're eager to master smart money concepts, improve your trade entries, and stay disciplined with your trading plan, make sure to hit the like button and subscribe to our channel. Before we begin, here are two key points to keep in mind. First, this trading setup is applicable across various markets, since price action remains consistent. Second, it is essential to fully grasp all the steps we outline before backtesting or implementing this strategy live. The FVG trading strategy follows a systematic approach that incorporates multiple smart money concepts to enhance accuracy. So, what is a fair value gap? At its core, a fair value gap, FVG, represents the price imbalance between three consecutive candles on a price chart. Specifically, in a bullish scenario, when the upper wick of the first candle does not overlap with the lower wick of the third candle, the space in between is marked as an FVG. But why is this significant? An FVG highlights a buy-side imbalance, indicating that buying pressure has outpaced selling pressure, often due to institutional activity. When the market experiences this inefficiency, price typically returns to the fair value gap area to fill or mitigate the imbalance. This concept is crucial because buy-side imbalances signal sell-side inefficiencies and vice versa. If you're a smart money trader, recognizing fair value gaps should be one of your first priorities when analyzing a chart. These gaps tell us where large market participants have influenced price action, and more often than not, the market revisits these zones to collect unfilled orders. For instance, on the Euro to US dollar 1-hour chart, we observe a bearish trend. The latest impulsive move started from a key level and extended downward, leaving behind FVG areas marked by large bearish candles. This signals a sell-side imbalance where price may return to the fair value gap to rebalance before continuing its move. By mastering the FVG trading strategy, you can gain a deeper understanding of market inefficiencies and refine your trade entries with higher accuracy. Stay tuned as we break down more real-time chart examples and strategies in this video. Understanding fair value gap. When price creates a fair value gap, it often needs to revisit these areas to patch them over, potentially offering a trading opportunity. In a strong downtrend, a sharp price move to the downside leaves behind an FVG. As price pulls back to this area, it frequently rejects the FVG and continues its downward momentum. This concept applies across all time frames. Whether you're analyzing the daily, weekly, or even lower time frames, you'll notice how price frequently forms and revisits FVG areas. For instance, on the EUR/USD daily time frame, we can observe an FVG between the lowest price traded on one day and the highest price traded the following day. This gap is the result of intense selling pressure and one-sided price action. Naturally, we expect price to eventually trade back into this FVG zone as price action seeks to rebalance these inefficiencies. Refining the fair value gap. For day traders, a daily FVG zone may appear too large to define precise trade entries. This is where the concept of refining the fair value gap becomes essential. By scaling down to a lower time frame, such as the 4-hour chart, we can pinpoint a more precise FVG within that zone. If the FVG on the 4-hour chart overlaps with the daily FVG, it becomes an even stronger area to look for potential trade setups, particularly for short entries in a bearish trend. This refining method isn't limited to fair value gaps. It can also be applied to order blocks, supply and demand zones, and other smart money concepts. Major news events in the forex and stock markets can cause sudden and significant price movements, often leading to the formation of new fair value gaps. During such times, traders must exercise caution as slippage can occur, leading to unexpected price changes. To mitigate risk, it's wise to secure profits, limit exposure, and always adhere to a solid risk management strategy. So, how to choose the right fair value gap? Before we dive into the next key concept, make sure to check the link in the description for valuable trading resources. Now, an important question arises: which fair value gap should you choose when analyzing the chart? Here we have several FVG areas marked, and the general idea is to wait for price to enter these zones before looking for potential buying opportunities. However, we are only interested in two specific areas. But why not the first zone? If we apply the Fibonacci retracement tool from the beginning to the end of the latest impulsive move, we notice that the first FVG is located above the 50% retracement level, the premium side of the range. The other two FVGs, however, are positioned below the 50% level in the discount zone. In a bullish scenario, we only look for long trades in the discount zone for several reasons. The market often takes out early buyers before making its actual move. Waiting for price to enter the discount area provides a safer, more conservative entry and reduces the chances of falling into a liquidity grab. In contrast, for a bearish setup, we follow the opposite approach. And the idea is to wait for price to pull back before entering a short trade. Using the Fibonacci retracement tool, we see that FVG is in the premium zone, while the other is in the discount zone. Since we want to sell from the premium zone, this becomes the ideal area for short setups. This approach provides a higher risk-to-reward ratio and works particularly well when the market makes deep retracements. However, if the market is trending aggressively, taking trades in the discount side of the range can still be profitable. So, what is our fair value gap trading setup? Now that we've covered the core concepts, let's move on to the second part of this video, where we break down a structured fair value gap trading setup. This trading plan consists of two major timeframes. Higher timeframe analysis. This is where we conduct most of our general market analysis. We will examine market structure, identify key levels, locate liquidity areas, and most importantly, pinpoint fair value gaps. Lower timeframe entry. After identifying high-quality FVG zones on the higher timeframe, we will zoom into a lower timeframe to find confirmation signals and execute our trades. This trading approach is not limited to any specific market or timeframe. However, a key rule is that your entry timeframe must be at least 2 times lower than your higher timeframe for better precision. Recommended timeframe combinations. Here are 3 timeframe combinations you can use depending on your trading style. For example, if you analyze FVGs on the 4-hour chart, your ideal entry time frame would be 15 minutes. Step 1. Analyzing market structure on the higher time frame. To understand the market direction and locate high-probability trade setups, we apply smart money concepts to the higher time frame chart. The key elements to analyze include break of structure, change of character, and liquidity sweep. Bullish scenario. On the candlestick chart, multiple breaks of structure to the upside confirm a bullish trend. However, at a certain point, price makes a liquidity sweep above a previous high. This often signals a possible reversal. If price breaks and closes below a key low, this confirms a change of character, meaning buyers have lost strength and sellers are now in control. Bearish scenario. For a bearish setup, a change of character happens when price trades below the lowest point of 2 consecutive highs. This significantly increases the chances of a trend reversal, especially if the market was previously in a long-term uptrend. By mastering these concepts and combining them with FVG trading zones, we can refine our entries and take high-probability trades with confidence. If the market direction on a specific time frame isn't clear, it's best to move on to another asset. Trading in an uncertain market environment increases the risk of making uninformed decisions, while focusing on clearer trends helps ensure better judgment and risk management. Shifting to a different pair allows traders to find stronger setups where the trend is more defined. Another key aspect of higher time frame analysis is identifying key levels. These levels serve 2 main purposes. They help pinpoint liquidity zones and potential reversal points, which act as our higher time frame targets. When analyzing a chart, we consider traditional support and resistance levels as significant liquidity areas. Equal highs and lows or multiple rejections at a price level often indicate zones where liquidity is concentrated. But why is identifying liquidity areas so important? Liquidity plays a crucial role in price movements. The market naturally gravitates toward levels where liquidity is present, while it moves away from areas where liquidity has already been taken. Understanding this behavior helps traders anticipate price movements more effectively. Additionally, when liquidity is swept before price reaches an optimal trading zone, it serves as further confirmation for a potential move in the expected direction. These key zones can also act as strong rejection points, making it essential to secure some profits before price reaches them. It's also crucial to evaluate how much space exists between the current price and a significant level ahead. This ensures that any trade taken offers a reasonable risk-to-reward ratio. The final step in analyzing market structure on the higher time frame is identifying fair value gaps, which will serve as our trading zones. However, after spotting these areas, we refine our approach by applying Fibonacci retracement levels. If the market is in an uptrend, we focus on fair value gaps located in the discount zone, as they provide better long opportunities. Conversely, in a downtrend, we look for fair value gaps positioned in the premium zone, as they present better selling opportunities. Once we've identified our optimal trading zone, the next step is to wait for the price to enter that area. At this point, we zoom into a lower time frame to look for reversal confirmations and execute a long trade. This is the core idea behind our strategy. Below is the checklist of concepts we apply on the higher time frame. Now, moving on to the second step of this trading plan: confirmation and trade execution on the lower time frame. Once the price enters our trading zone, we need a clear signal that the short-term downtrend is coming to an end and that the price is likely to reverse upward. To identify this shift, we focus on liquidity sweeps and changes in character. A valid liquidity sweep below a key low suggests that a reversal might be imminent, and if the price then breaks above a key high, it confirms the change in character. Once the reversal is confirmed, we move to trade execution. The setup involves waiting for the price to create fair value gaps on the lower time frame. After identifying these zones, we set a buy limit at the start of the fair value gap and place our stop loss just below it. For risk management, we secure our first target at a 1-to-2 risk-to-reward ratio, where we close half the position and move the trade to break even. The next target is the first significant level ahead on the higher time frame, which acts as our final exit point. Before diving into real chart examples, let's go over two common scenarios traders face and how to manage them. A very small fair value gap. When the identified gap is tiny, the price is more likely to fluctuate around it. In this case, we use a wider stop loss to avoid getting stopped out by normal market movements. A large fair value gap. If the gap is too wide, placing a stop loss below the entire zone results in a high-risk trade. Instead, we can either use a smaller stop loss just below a more refined section of the gap. Enter at the midpoint of the zone to improve the risk-to-reward ratio. This is the checklist of concepts we apply on the lower time frame. Real chart example. Now let's analyze a real chart example. On the EUR-USD 1-hour chart, the market was in a downtrend until we identified both a liquidity sweep pattern and a change of character. These two signals indicated that sellers had lost control and that the market direction had shifted to bullish. In this scenario, we can identify two fair value gap areas, but only the one located on the premium side of the range is considered a valid trading zone. The next step is to wait for the price to enter this FVG area and then zoom into a lower time frame to look for potential long trade opportunities. On the 5-minute chart, we observe that the price has broken above a key level, signaling a change of character, which confirms the potential reversal. At this point, we identify a new FVG area on the 5-minute time frame. The trade setup involves placing a buy order at the start of this zone while positioning our stop loss just below it. The long-term target will be the next significant level ahead of the price. Example: Gold 1-hour chart. Looking at the gold 1-hour chart, we see a downtrend in progress with fair value gap areas that could provide short trade opportunities. We then wait for the price to return to this area and zoom into a lower time frame to execute the trade. On the 5-minute chart, we identify a change of character along with a fair value gap area. The next step is to place a sell order at the beginning of the FVG zone while setting our stop loss above it. Now, let's see how this trade plays out. Managing losses in trading. As we can see, this trade resulted in a loss. This is a reality that all traders must accept. No trading strategy guarantees a 100% success rate. Even with a solid plan and accurate analysis, losses are inevitable. The most important takeaway is to stick to your trading rules and follow your risk management strategy. As long as you manage risk effectively and remain disciplined, losses will be just a part of the bigger picture. That's it for this session. If you found this guide valuable, don't forget to hit the like button to show your support. And if you're new here, consider subscribing for more trading insights. See you in the next episode.